Ritu, thanks for inviting me to speak today. I must stress that the vast majority of our experience in retail is as advisors to foreign institutional investors. So Ambit Capital primarily acts as an advisor to, say, a Capital or a Fidelity or a Genesis when they look to make investments in Indian retail. And I think as my two co-panelists were saying, there are aspects of Indian retail that FIIs have fallen in love with, and there are aspects of Indian retail that FIIs sort of run a million miles away from. And let me quickly sort of go into that, because that will lead into Ritu's question on what exactly should a company do if they want to get ready for going public. If you go to America or Europe and try to convince a foreign investor to invest in Indian retail, the three specific issues they tend to focus on very heavily are, firstly, real estate cost. I think everyone out there now knows that Indian real estate is almost prohibitively expensive, and that's a big worry for investors as to can you really scale retail formats in our country given how expensive real estate has become, especially in the larger metros. The second is formats and layouts. I think it's not yet clear to anybody that the learning process in Indian retail is anywhere near done. Even in smaller retail formats, what's the best store layout, what are the best store locations, what products should we keep, what sort of staff should we hire. There is so much learning that's still being done that's something that FIIs are very wary of. They don't want to pay for a retailer to learn with their capital. And the third issue is supply chain. We all know the issues with infrastructure in India. The practical manifestation of our infrastructure deficits is that it's very difficult to scale a supply chain in our country. Now, given these three issues, there are aspects of Indian retail which have actually been able to deal with these three critical issues. And simply put, single format, single brand, small format retail. So a Titan, a Bata, a Jubilant Foodworks in the listed space are classic examples. You're looking at small format stores and it's a single brand offering. This is the format that FIIs have fallen in love with. They've seen that you can deal with real estate cost issues by keeping the format small, supply chain issues by keeping a very small, very tight offering, and deal with the whole scaling up quite successfully. So if you look at the stock market today, you'll see these sorts of companies trade at 25, 30, 35 times earnings. The part of Indian retail that the foreign investor is incredibly wary of is where none of these hold true. So multi-brand retail and large format multi-brand retail. You're sort of taking on all of these three problems around logistics, around supply chain, around real estate, around learning. You're taking on these problems head on, and the foreign investor really wants to run away a million miles from that format. Now that's the backdrop. That's the backdrop against which all of us have to operate. And hence, when we meet companies that have got retail ventures and they are contemplating going public, what we stress to them is to pare down the offering to a tight focused group of products or a tight focused format that can be sold in a compelling fashion to the stock market. So if you're offering, if your company is retailing 35 products or 50 products, we say focus on 5 to 10, which are making money, which are your what I would call power brands. Focus on a subset of your stores which are doing well, and grow that format for 3 to 4 years before you take it public. One simple financial metric which I think encapsulates this journey is ROCE. ROCE is the metric that I think most investors focus on heavily. And typically, if you're taking a business public and you want a rich valuation, a 3 to 4 year positive ROCE progression heading somewhere towards 20%, I think is essential. Without that, you really won't be able to do justice to yourself. Couple of other points of hygiene that we tend to advise companies to take on board before they go public is find a good auditor, ideally a Big Four auditor, I would say, an auditor that a global investor will say, okay, we know these people, they are reliable auditors. It's not to say that there's any audit firm out there which is perfect, but a credible, well-known auditor does give a huge amount of confidence to a foreign investor. And the final piece is have on your board of directors at least one or two well-known non-executive non-executive directors. Trustworthy, reliable, high reputation figures, which again the market will look at and they'll say, if so-and-so sits on the board of XYZ company, we can trust the governance, we can trust the management team. So that's the broad construct. There are aspects of Indian retail where the foreign investor has deeply fallen in love with. 25, 35 times earnings is very feasible. But there are other aspects where there are serious issues around scalability, logistics, and the very viability of those franchises in India.